Okay, well, good morning, everyone. My name is James Welch. I'm a corporate tax partner here at BDO, and I'm going to be delivering the corporate tax update. The first area I'd like to go through is just really to give my thoughts on the current corporation tax landscape. Uh, I'm sure everybody's aware that the various furlough schemes and grants had an awful cost to the country and do need to be paid for. Uh, I'm also sure you're aware that the corporation tax rates are increasing to 25% from April next year. Now, that hasn't really started to bite, obviously, as yet, other than, I suppose, for deferred tax on balance sheets. Uh, the point I really wanted to just talk about was it's not just the rate that's going up. The tax scope has increased and is continuing to increase. Uh, a good example of this is the taxation of non-residents. We've got non-residents capital gains tax on real estate and also non-residents corporation tax for landlords. And both of those regimes will significantly increase the tax take for non-residents investing in the UK. An example of one that is coming, again, actually April next year, is a minimum tax rate of 15%. And this is a global tax initiative, which the UK is early adopting from April next year. You may be thinking, well, hang on a second, 15% compared to 25%, that won't make any difference. Well, it may not do. First of all, I should actually say it's only aimed at very large corporates, those with turnover over 750 million. But it's an accounting-based test, and also it's aimed at subsidiaries, overseas subsidiaries that are taxed at a very low base. So if you are in this regime, it is certainly one to look out for. Anti-avoidance rules are growing year on year. I can still remember where my tax legislation was just one book. It's now 4 books, and it wouldn't surprise me if that goes up to 5 books next year. So in this environment, can you actually do any tax planning? Well, answer yes, but it has to be commercially driven. And a good way, I think, to consider this is that the tax planning has to be the cherry on the cake. If the tax planning is the sponge, the icing, and the cherry, then I think you're going to run into problems. I think it's also worth saying that tax planning has to be seen to be commercially driven. A lot of non-residents have invested in the UK through Guernsey, BVI companies, and whilst these still work, there's probably not that much of a tax difference between investing via a UK company. And I know certain banks certainly prefer investors to use UK companies rather than those with a perception of tax avoidance. The next point I really want to go through is that the high-level rules on corporation tax, in some respects, are a little bit simpler than they were 10 years ago. I'm thinking here of losses. It's a lot easier to get current relief for losses across a group than it was. There is, of course, a lot of detail here. It's still quite difficult to get relief for old losses before the regime came in. A lot of the current tax reliefs are focused on trading activities. So, I mean, if you own a hotel, that's good news. If you trade the hotel, it's not quite so much good news if you actually are a landlord and lease the hotel out to a third party. I mean, examples of these are inheritance tax, where you typically get full relief or 50% relief. Capital gains tax, if you are a corporate group selling, you'd expect to get a complete exemption through substantial shareholdings, and construction industry scheme. And I'll come back to that last point in a couple of minutes. So I've been very busy advising on transactions in the last 2 or 3 years, and that is simply a function that there's an awful lot of transactions around. Most corporate finance departments are very busy and pretty much at capacity, really. Most asset-based transactions, for instance, on hotels, with a value of more than £10 million, are typically structured as a share sale rather than an asset-based sale. And really, just to consider why that is, you look at it both from the vendor perspective and the purchaser perspective. From the vendor's perspective, if you're selling a trading subsidiary, you're probably looking at a tax-free disposal if it's corporate, reduced if it's an individual selling. And that kind of means that the base cost in a subsidiary is largely irrelevant because it's going to be exempt through a substantial shareholdings exemption. If you do have non-trade elements within a subgroup you're looking to sell, it's definitely the case that early planning is required. You may need to do a demerger to get the relevant bit out to access these reliefs. From a purchaser's perspective, the big benefit is stamp taxes. By buying a corporate, you're paying 0.5% on the value of the company. If you buy the asset, it's typically 5%. And you're also looking at acquiring the losses. Just one point before I move away from this slide. I mean, this is the current situation. It really wouldn't surprise me if this does change. I mean, the stamp tax benefit is a huge differential here, and it's really not beyond the realms of possibility that this will change going forward. We've seen specific tax measures for non-residents aimed at property-rich disposals, and it'd be quite easy, I think, to do that for stamp taxes. I must make it clear this is the my personal view, not a BDO view. But if I was Chancellor, it's something I would look at probably at some point in the next 5 years. So with all these share sale transactions, that does mean a lot of diligence needs to be done on the companies to get the purchasers comfortable with the company. The first two I'm not really going to talk about. Furlough claims will be talked about by Jackie. National minimum wage is not a tax point, so I'm not going to go through that. A good example, I think, of just how complex the rules have got is on interest relief. So where a company is paying interest either to a bank or to a shareholder. In order to get tax relief for that interest, you have to satisfy the anti-hybrid rules, the corporate interest restriction rules, transfer pricing rules, and targeted anti-avoidance rules. And it's only when you've satisfied all those 4 tests, then you can successfully claim the relief. So little doubt it's quite often a major issue in diligences. Construction industry scheme. This is rearing its head more often these days. There is a general carve out for CIS for trading companies, so where you own the hotel and trade the whole lot as a hotel. But if you lease part of it out, then you cease to be trading in the eyes of HMRC, and you could well be caught by the construction industry scheme. It's a point I've seen HMRC take in practice. Being honest with you, I've seen more and more in diligences. So it's a good point to bear in mind. Well, I'll now pass on to Jackie, who will talk about furlough and other issues. Thanks.